Welcome back to the Deep Dive. Thank you so much for tuning in. We are, of course, the show that takes these incredibly dense, complex documents you send us, filings, research, memos, and we just distill them down into the essential knowledge you need. We're the shortcut to being truly well-informed. Today, we are definitely strapping in for a very extensive and I think necessary deep dive into the Q3 2025 Form 10Q from Getty Images Holdings, Inc. That's ticker GETY. Now, if you've ever tried to read one of these quarterly reports, you know they are absolute labyrinths of legal jargon, accounting footnotes, risk factors. It's a lot. So our mission today is to cut right through all of that complexity and pull out the critical operational and financial insights that really define what's going on at one of the world's biggest content marketplaces. But before we jump in, a quick favor. If you find this analysis helpful, and we really think you will, please just take a second and click that like button. Share this deep dive with anyone else who needs this kind of shortcut. Subscribe to the channel if you haven't, and definitely stay tuned. Your support is what helps us keep doing this.
And this is a really essential one to understand because Getty Images is, well, it's not in a quiet period right now, not at all. For anyone who needs a bit of context, Getty Images is a global powerhouse in visual content. They run the main Getty Images brand, the more budget-friendly iStock, and of course the huge free content site Unsplash. They're serving everyone. I mean, from major Hollywood studios down to small businesses and individual creators. But this quarter, the 3 months ending September 30, 2025, wasn't really defined by normal business growth. It was almost completely dominated by two massive strategic maneuvers that just overshadow every single number we're about to talk about. First, a really significant, very high-stakes debt refinancing. And second, the proposed merger with their biggest rival, Shutterstock, which is proving to be incredibly scrutinized and, frankly, incredibly expensive. So as we go through this, you have to filter every piece of data through the lens of those two massive events.
Okay, let's do it. Let's unpack this, starting with those headline numbers. We're looking at the 3 and 9 months ended September 30, 2025. And right away, when you look at the core numbers, you see something. Well, it's jarring. The top line looks stable, but the bottom line is just wild, almost nonsensical volatility.
That's a perfect way to put it. The operational story, the recurring revenue, that's more or less intact. But the financial story, it is completely dominated by these huge one-time non-cash charges that are all tied to how they manage their massive pile of debt. So let's break down those core results. I'll focus on the year-over-year changes.
Correct.
For the 3 months, so Q3 2025, revenue was $240 million.
Okay.
Which is basically flat. It was down 0.2% reported, or 2% on a currency-neutral basis.
Yeah.
That currency-neutral number is key because it shows the underlying business slowed down a bit before you factor in any currency tailwinds.
Right.
Net income, though, was $21.6 million. And that looks like a huge win compared to the $2.5 million loss they had in Q3 of 24.
A big swing.
Huge swing. Diluted EPS was 5 cents per share. And then adjusted EBITDA margin, which is really the best measure of their core operating health, was 32.8%. That's down just a little from 33.5% last year. So a little pressure on profitability.
Okay, so that's the quarter. What about the year-to-date picture?
So for the 9 months ended September 30, revenue was $699 million. That's up slightly, 1% reported. But the net loss, it was a massive $115.3 million.
Wow.
I mean, a dramatic reversal from the nearly $15 million in net income they had for the same period last year.
That's a huge difference.
It is. So that's a loss of 28 cents per share. And again, adjusted EBITDA margin 31%, down a bit from 31.7% last year. So again, that confirms a slight operational squeeze.
Okay, I have to stop you there. That contrast it's really confusing. How can a company report a $21 million profit in one quarter, Q3, but still have a colossal $115 million loss for the year to date? That doesn't sound like a business that's performing poorly. That sounds like some kind of massive one-off financial event happened earlier in the year.
You've hit on the absolute central accounting challenge here. That huge swing, it's almost entirely non-operational. It's non-cash, so it didn't reflect the actual day-to-day business of selling content.
Yeah.
Getty is a very debt-heavy company, and a big chunk of that debt is in other currencies, mostly the euro.
Ah, okay.
So the single biggest reason for that crushing year-to-date loss is foreign exchange volatility. Getty had to recognize a staggering $78.4 million in net foreign currency transaction losses this year.
78 million.
Exactly. When the euro fluctuated against the dollar, the value of their euro-denominated debt when they translate it back to dollars for the report suddenly looked much, much larger. And that creates this massive non-cash loss on the income statement.
So if that $78 million loss is non-cash and it's tied to valuing long-term debt, then that $115 million loss for the year is pretty misleading about the health of the actual content business. But even if we just look at the positive $21 million in Q3, that number also got a big one-time boost, didn't it?
It absolutely did. The pre-tax income for Q3 was actually pretty low, just $11.6 million.
Okay.
What pushed it up to that $21.6 million net income was a huge $10.1 million income tax benefit they recorded in the quarter.
So a tax benefit, not operating profit.
Precisely. The business itself generated $11.6 million before taxes, but some favorable tax accounting gave them another $10 million on the bottom line. So, while Q3 was definitely an improvement from a loss last year, the core operating strength, that adjusted EBITDA margin, is still feeling some pressure.
And since this 10Q doesn't give us any explicit forward guidance, we kind of have to play detective and figure out the outlook from the risks they list. What are the big financial headwinds that are basically guaranteed to hit them in Q4 and into next year?
The biggest headwind is the cost of their ambition. It's the cost of trying to merge with Shutterstock. We know they expensed $9.9 million in Q3 alone.
Just in one quarter.
In one quarter. Just for lawyers, accountants, advisors, that brings the year-to-date total to $38.3 million. These are very expensive people working on a huge regulatory battle, and those costs are absolutely going to continue, especially now that they're in that CMA Phase 2 review in the UK.
And the second major financial overhang is that warrant litigation we're going to talk more about later.
Exactly. They are continuing to accrue interest on that massive $115.5 million litigation reserve they've set aside. That reserve is a major liability just sitting on the balance sheet, and until those appeals are finished, the legal defense costs and the interest on that judgment will just be a constant non-operational drain on their cash.
But let's pivot to a positive for a second. There's a legislative tailwind mentioned in the filing, the One Big Beautiful Bill Act, or OBBBA. What is that, and why does it help Getty's tax bill?
So the OBBBA, which passed in July, is a pretty significant piece of U.S. tax law. The name is a little absurd, but the impact is real. It mainly deals with things like R&D amortization rules. The key takeaway for Getty is that this bill is expected to reduce their annual U.S. tax liability by about $4 to $7 million in 2025. In the context of that $10 million tax benefit, a permanent $4 to $7 million reduction every year is a really solid, clean boost to their net income going forward.
So to sum up the financials, the big YTD loss is mostly accounting noise from currency on their debt. It's not an operational collapse. But the core business is seeing slightly declining margins, and the company is burning tens of millions on merger costs while accruing interest on a huge legal judgment. The story here isn't revenue growth. It's all about strategic maneuvering and managing risk.
That's it, exactly.
Okay, here's where it gets really interesting for me. That flat overall revenue number, down just 0.2%, it hides a really fundamental and, frankly, intentional shift in where Getty is making its money. When the whole picture is flat, you have to look under the hood.
That's a crucial insight. The report shows two completely contradictory trends happening at the same time. On one hand, you've got creative content showing really robust growth, which is exactly what they want.
Right.
On the other hand, editorial content is shrinking, but for reasons that are entirely predictable and, cyclical.
So let's start with the good news, that momentum in creative content. This is their core business, right? Royalty-free images, videos, illustrations. How strong was Q3?
Creative revenue in Q3 was $144.9 million. That's an impressive 8.4% reported increase, or 6.4% currency neutral. The main driver here was a big uptick in what they call premium access subscriptions. That one product line accounted for a $10.4 million increase in the quarter.
Okay, but there's a catch there, right? Something about how they recognize the revenue.
Yeah, there's some important nuance. The report says that the Q3 surge included a major multi-year deal they signed, where a big chunk of the revenue was recognized up front. So when you book revenue from a long-term contract immediately, it gives the current quarter a nice boost, but it makes the comparison next year that much harder. It's a valid accounting practice, but it means Q3 was probably a little artificially inflated by that one big deal.
That makes sense.
Yeah.
But even if we look at the whole year so far, that strategic pivot is still pretty clear, even if total creative revenue was slightly down overall.
Absolutely. The year-to-date creative number was pressured mostly by declines from their traditional agency customers. And those are the clients who mostly buy things.
Hmm.
A la carte, the old paper download model.
We're moving away from that.
They are. And that loss of transactional revenue was almost completely offset by a really robust $14.8 million increase in creative subscriptions for the 9-month period. And that is the whole thesis of Getty Images right now. Replace the volatile transactional revenue with sticky, high-value subscription revenue. And you see it in the numbers. Creative is now 58% of their year-to-date revenue, and almost 60% of that creative revenue is now subscription-based. That's huge. That's why they can afford to lose some of those lower-value customers.
That shift to predictability is huge, but let's look at the other side of it, editorial content. This is news, sports, entertainment, photography. It was down 3.7% in Q3. Is that a sign that demand for news coverage is weakening?
Not necessarily, and this is where, digging into the filing really pays off. The report gives a very precise cyclical reason for that decrease. The period they're comparing it to, Q3 of 2024, was just packed with huge quadrennial sporting events. Plus, it had all the U.S. political spending leading up to an election.
Right, like the Olympics and the Euros.
Exactly. The UEFA European Championship, the lead up to the Paris Olympics coverage, these things generate massive short-term demand for high-margin editorial content that just didn't happen in Q3 of 2025. That revenue is always going to be lumpy.
So the drop isn't a failure of the product, it's really just a timing issue with the global sports and political calendar.
That's it. And when you look at the underlying health, their editorial assignments and subscriptions actually grew. What fell off a cliff were the a la carte sales, which were down over $7 million for the year, and that's tied directly to the cycle of those big events. The core, recurring editorial subscription business is still solid.
Okay, now let's tackle the most volatile part of the business. Other revenue. This is often where we see companies monetizing new tech, like data licensing for AI model training. This category just plummeted, down 58.5% in Q3. What's the reason for that kind of catastrophic drop?
Again, it's an accounting distortion. It's all about timing and scale. This category fell because of a huge deal they signed back in Q3 of 2024. It was an expanded 5-year content deal with an existing customer. And the revenue for that multi-year deal was largely recognized upfront in the prior year. So if you book years of revenue in 2024, the comparison in 2025 is going to look terrible no matter what.
But if we zoom out to the full year, the story is completely different, isn't it?
Completely. If you look at the full 9 months, other revenue is actually up 20.1% overall.
Wow.
And that's thanks to new data access and licensing deals, including new AI training agreements. So while that Q3 drop looks like a disaster, the underlying data licensing business is actually growing. But it's growing through these very large, very chunky, and inherently volatile deals. It's an unstable engine, but it is running hot.
So if we put all this operational data together, the strategic shift to subscriptions is really the anchor here. It's what's giving them the resilience to handle all this other volatility.
That's the key takeaway. The operational pivot is working. Annual subscriptions are now about 56% of their total revenue for the 9 months. This increases predictability, it increases stickiness. They are successfully replacing the transactional user, the person who downloads one photo every 6 months, with the committed subscriber. That's what will stabilize their cash flow in the long run.
That operational stability is so critical because they absolutely need it to weather the storm around this Shutterstock merger. This is arguably the highest stakes move Getty has made in years. So what is the absolute latest on this deal?
Well, the merger is massive. It's structured as a merger of equals, though Getty stockholders would get the slightly larger piece, about 53.5% of the new company. The deal itself is a mix of cash and stock for Shutterstock shareholders. But this isn't a simple acquisition. I mean, this is the two biggest players in the commercial stock content space trying to combine. And that scale is exactly what's causing all the regulatory problems.
Okay, let's dive into those regulatory hurdles because they are eating up tens of millions of dollars and delaying everything. What's the status in the U.S. and the U.K.?
In the U.S., the Department of Justice, the DOJ, issued what's called a second request way back on April 2nd.
And a second request is not a minor thing?
Not at all. It's a formal, exhaustive, and incredibly expensive investigation. It means the DOJ has serious concerns about competition and needs to analyze just mountains of internal data pricing models, competitive strategy, to see what the impact on the market would be. This can take months and months and often ends with them demanding changes to the deal before they'll approve it.
And internationally, it's gotten even worse since the quarter ended.
Yes, dramatically worse. On November 3rd, the UK's Competition and Markets Authority, the CMA, officially referred the merger to a Phase 2 review.
Which is the highest level of scrutiny they have.
It's the highest level. Phase 1 is a quick check. Phase 2 is an in-depth investigation by an independent panel that can take 6 months, even a year. They're looking at fundamental competition concerns, and this referral introduces a very real possibility that the deal could be blocked or they'll be forced to sell off parts of the business.
Let's just put a finer point on the financial pain here. We mentioned the $38 million year-to-date cost for this merger. That's a huge amount of money. What's the opportunity cost of spending that much on a deal that might not even close?
The opportunity cost is critical.
Yeah.
$38 million in operating expenses is $38 million that can't be invested back into the business.
Right.
That's money that isn't going into R&D for better search tech, or into growing their Unsplash Plus subscriber base, or acquiring new exclusive content. Instead, it's all defensive. It's just paying lawyers to fight the government. This financial drain could be one of the reasons we're seeing that slight pressure on the EBITDA margin. They're fighting a two-front war right now.
And to even make this deal possible, they've had to take on some really complex and risky debt. We need to talk about the two big offerings that happened right after the quarter ended, because they are betting billions on this merger actually closing.
These moves show you just how committed they are. It's the definition of high-stakes leverage. So first, on October 21st, they closed on $628.4 million in 10.5% senior secured notes.
10.5%.
10.5%. An enormous offering. And the proceeds were immediately put into an escrow account. This money is specifically to fund the cash part of the merger and to pay off Shutterstock's debt when the deal closes.
So the money is there, but it's locked away. What happens if the DOJ or the CMA says no and kills the deal?
This is where the risk is just immense. It's like a financial hostage situation. If the merger agreement is terminated, or if it doesn't close by October 6th, 2026, those $628 million notes must be redeemed at par. They'll have to pay back the full amount plus interest in a very short amount of time. They've effectively taken on over $600 million in debt at a very high interest rate with a mandatory payback clause if the regulators kill the deal. It puts a huge ticking clock on everything.
And the second debt action was about cleaning up their existing liabilities to make the whole thing work.
Correct. On that same day, they did an exchange for their unsecured debt. They swapped about $295 million of their old notes for new 14% senior unsecured notes.
14%? That is an incredibly expensive interest rate. Why would they agree to pay that much?
They did it to get consents. This exchange was necessary to push out the maturity dates on that old debt, which was a key condition in the merger agreement. They basically paid a massive premium, that 14% coupon, for debt certainty and to keep the deal on track.
So this leads us right into the balance sheet. With all these maneuvers, the refinancing, the new escrow debt, how is this massive debt load really impacting the company? We already saw the $105 million in interest expense this year.
Well, the big refinancing earlier in the year was a smart move to buy time, but that time came at a very high price. They successfully pushed their big maturity dates out, so they don't have a debt crisis looming, but they locked themselves into very expensive fixed rates.
Right.
It started back in February when they retired their old 2019 loans and replaced them with new 2025 term loans. That extended the maturity out to 2030, which gives them a lot of stability.
But then they immediately did another complex swap in May.
Why? That was strategic. They exchanged most of those new USD term loans for $540 million of 11.25% senior secured notes. The key there is moving from a variable rate loan to a high fixed rate note. In this economic climate, paying 11.25% is painful, but it buys you certainty. They know exactly what their interest payments will be through 2030, which protects them from any unexpected rate hikes from the Fed.
And this kind of activity must have had huge upfront costs, right? Beyond just the interest.
The cost of extinguishing that old debt was significant. For the 9 months, they took a $5.5 million loss on extinguishment of debt. On top of that, another $6 million in third-party costs for the refinancing were expensed immediately. So in total, they paid over $11 million in one-time fees just to restructure their debt. And the result is that year-to-date interest expense of $105 million. So they have stability until 2030, but the mortgage on the business is way more expensive now.
That cost of debt is massive, but it's dwarfed by the single biggest liability on their books, which comes from the company's past life as a SPAC. Let's talk about the litigation reserves for that warrant litigation.
This is a huge material financial risk that goes right back to how Getty went public in 2022. The lawsuits were filed by former warrant holders who argued the company improperly redeemed their warrants and basically cheated them out of their value. And the scale of the exposure is just staggering. As of September 30th, the total litigation reserve is $115.5 million.
115 million. I mean, to put that in perspective, that is the same size as the entire YTD net loss we talked about. It's just an enormous non-operational hit. How much of that is covered by insurance?
There is some, but not enough. The company has an insurance receivable of about $37 million left against $60 million in total coverage. So that means if these judgments are upheld, almost two-thirds of that $115 million, so roughly $78 million, would have to be paid directly by the company. That liability is just sitting there, accruing interest, eating up cash.
Are they writing checks for this right now?
No, not yet. All the judgments are currently under appeal. The Second Circuit Court of Appeals heard arguments back in January, and a decision is pending. The company is fighting it hard, but until that decision comes down, this $115 million reserve is just hanging over the balance sheet.
So let's pivot from that past liability to the forward-looking legal battle that could define the company's future value. The AI litigation against Stability AI. What's the core argument in those lawsuits?
The core allegation is simple, but it's globally consequential. Unauthorized reproduction. Intellectual property theft. Getty alleges that Stability AI used approximately 12 million of its images, copyright-protected content, to train their generative model, Stable Diffusion, without a license and without any compensation. This case is fundamentally about whether content creators get paid in the age of generative AI.
Let's talk about the big recent development, that UK High Court ruling. It sounds like it was a mixed bag for Getty, but the underlying finding was huge.
It was a mixed verdict, but the monumental part is what really matters. Getty won on trademark infringement. The court said the AI output often included the Getty watermark, which is a clear violation. They were unsuccessful on a secondary copyright claim.
Okay.
But, and this is the detail that will echo around the world, the court explicitly found that Getty Images' copyright-protected works were used to train Stable Diffusion. That factual finding is a massive victory for content creators.
Why does that specific finding matter so much?
Because it establishes the factual premise for everything else. It proves that a major AI company used millions of copyrighted assets without permission to build their commercial product. That finding is the foundation for future damages, for potential injunctions, and most importantly, for leveraging future licensing deals. For you, the listener, this fight is defining the future commercial boundaries of AI. It asks the question, does the content creation industry get paid for its training data, or is its entire library just free labor for Silicon Valley?
That is a perfect transition because all of this, the debt, the legal fights, it's all designed to protect the core operational business. So let's look at the KPIs, the key performance indicators over the last 12 months to really gauge the health of the engine.
The KPIs are essential. They show us how well management is actually executing on that strategic pivot away from the old transactional model.
Yeah.
And they really do confirm that the transition is working, even if some of the numbers look negative at first glance.
Okay, let's start with the one that seems weird. Total purchasing customers. That number went down 2.3% to 703,000. Why would they want fewer paying customers?
Because they're trading low-value volume for high-value engagement. That decrease is driven by the drop in a la carte or transactional customers. The people who used Getty once a year are going elsewhere or just aren't being prioritized. And this is confirmed by the fact that the average revenue per purchasing customer actually grew by 5.5% to over $1,300. So they lost 16,000 customers, but the ones who are left are spending way more and are more committed.
That context makes the next KPI, total active annual subscribers, the real test of the strategy.
Absolutely. Total active annual subscribers was up 1.7% to 304,000. This is the metric that proves the pivot is succeeding. It's slower growth than you might hope for, but it's steady, and is partly driven by Unsplash plus subscriptions bringing new people into the paid ecosystem. Every one of those new subscribers is stable, predictable, recurring revenue.
But wait a minute, 1.7% growth in subscribers. That sounds a little sluggish for a major strategic pivot, doesn't it? Is that pace really fast enough to offset the decline in those other customers, especially when you're spending 38 million on a merger?
That's a fair point. It's the key operational vulnerability. 1.7% is growth, but it's not explosive growth. It suggests the market for these enterprise solutions is pretty mature and the competition is fierce. They need to accelerate that growth, which is probably a big reason why they're so focused on the Shutterstock merger, to gain scale fast. Right now, the pivot is working, but it's working slowly.
What about subscriber retention? The annual subscriber revenue retention rate went down to 90.3%. Is that sluggish growth plus lower retention a sign of weakening product stickiness?
Again, the filing points back to that operational cycle we talked about. The decrease is tied to the absence of those big political and sporting events. A lot of their big subscribers budget a huge amount for those events. When the events don't happen, the customer's total spend goes down, which makes the retention rate look lower, even if they're still a happy subscriber. It's more a measure of revenue consistency than actual customer churn.
And what about the content itself? Are they still investing in growing the library?
They absolutely are. They have to. The image collection is up almost 7% to 600 million assets, and the video collection is up over 13% to 35 million assets. That confirms they're still investing heavily in content, which is essential to keep those high-value subscribers happy.
And finally, the video attachment rate was flat at 16.4%. That's the percentage of customers using video. Given how big video is, why is that number stuck?
Yeah, the flatness there suggests a couple of challenges. Video is a massive growth opportunity, but the flat rate might mean the product integration isn't great. It's not easy for an image subscriber to start using video. Or maybe the competition, like Adobe Stock, is just stronger in that area right now. The company knows video is a growth area, so the fact that this isn't moving suggests they still have a lot of work to do on the user experience.
Okay, let's bring it all together. Based on everything in this very dense filing, what are the 5 most important takeaways that our listeners need to remember about Getty Images right now?
This quarter was complex, but I think 5 themes really stand out and define their immediate future. First is merger uncertainty and cost. The Shutterstock deal is stalled by serious regulatory challenges, the DOJ second request, the CMA Phase 2 review. It's already cost them $38 million this year, and its completion is tied to that massive $628 million in new, high-risk escrow debt that has to be paid back if the deal fails. It's a coin flip with a billion-dollar price tag. Second, debt restructuring and high interest. They bought themselves 5 years of stability by refinancing their debt, but at a huge cost. They're now carrying fixed rates of over 11% and even 14% on some new debt. This raises their cost of capital and acts as a major drag on their ability to invest in the future. Okay, 2 down. What's number 3? Number 3 is that the core business pivot is working, but slowly. The strategic shift to annual subscriptions is happening. Subscribers are up, revenue per customer is up. The pace is a bit sluggish, but the strategy of replacing low-value transactional customers with sticky, high-value subscribers is creating a more resilient business model. Fourth is the major litigation overhang. That $115 million reserve for the warrant litigation is a huge financial threat, and crucially, almost 2/3 of it might be uninsured. That payment, plus the interest, is an enormous risk to their cash position until the appeals court makes its ruling. And finally, number 5 is the AI and data revenue dilemma. Revenue from big data licensing deals is volatile, as we saw, but the underlying business is growing 20% year to date. This high-growth area is being fiercely defended in the Stability AI lawsuits, where they've already gotten that key finding from the UK court. This legal battle is central to determining the future value of their entire content library.
What a dense and fascinating deep dive. This quarter was just so clearly defined by these huge, expensive strategic moves, the merger, the debt refinance, and all the financial risks from litigation and currency. And yet, underneath all that noise, the core strategy to shift the business to a stable subscription model is, well, slowly moving forward.
Excellently. And while the near-term risk from the debt and the merger is what's dominating the balance sheet right now, I think the ongoing AI litigation against Stability AI is probably the most significant long-term story for Getty, and really for the whole content industry. Getty is on the legal front line here, fighting to secure compensation for creators whose work is being used to train generative models. So, the provocative thought I'd leave you with is this. The UK court has already established that Getty's content was used to train Stable Diffusion. What will the final verdict be on the ultimate copyright boundaries for AI? And how will that ruling define the future value of a content marketplace? If creators get robust compensation, Getty's assets are suddenly worth a whole lot more in this new AI ecosystem. If they fail, the long-term value of their entire library could be significantly diminished. That really is the trillion-dollar question hanging over the entire content world today.
A question that defines the value of almost all digital content from here on out. That is a powerful thought to end on. Thank you for joining us for this deep dive into the Getty Images Q3 2025 filing. We really encourage you to follow up on your own and maybe research the specific conditions on that $600 million escrow debt for the merger. It's a masterclass in financial engineering. Or explore what the OBBBA tax changes really mean for U.S. corporations. And one final reminder from us, please click the like button, share this deep dive with your network, subscribe to the channel, and stay tuned for our next one. We'll catch you next time.